Okay, I'm going to call to order the regular meeting of the Joint Retirement Investment Board, Wednesday, February 23rd, 2022. And the second item on the agenda is I'd like to get a motion to hear, consider, and approve the minutes of the regular meeting of January 26th, 2021. I think that should be 2022.
Yep.
Is there a motion to approve those minutes?
Nick Bruce raised his hand.
Nick? Nick, did you make a motion? Okay. Is there a second?
I'll second.
Who's that? Chris? Thanks, Chris. All right. It's been approved and seconded. Any discussion on the minutes? Seeing none, all those in favor say aye.
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 Any opposed? Any abstention?
Russ Atkins.
Russ Atkins abstains. Anyone else? Okay, the item passes. And we'll move on to item number 3, the performance review from Vanguard. Brian.
All right. Thank you, Jared. Good evening,
Thank you.
everyone. Jared, are you able
Welcome.
to bring up the presentation?
I can do that.
Share screen, and then
Yep.
we'll go through it.
Yep.
And as Jared's pulling that up, I'll, a brief update on performance for both the pension and OPEB as we usually do. I didn't include any special topics this month. We've covered some in the past, but I always welcome your questions as we go along or even as we open up. Okay, great. I see it, Jared. And we'll start right on, as it's scrolling through, start right on page 4. Yeah, we'll start right here.
So here, okay.
And so clearly we've seen, this is through the end of January. We've clearly seen some downdraft in both equities and fixed income. Usually those are, move in reverse, but we saw negative prints in both equities and fixed income for the month of January. Of course, we've had continued turbulence in February with the standoff in Ukraine. But just speaking through January, what really drove the downdraft was more aggressive expectations by the market as far as how much the Fed would hike here in 2022. That second bullet really sums it up nicely. Is coming into the year, the market, the market's always forward looking, right? They were expecting, let's call it 3 hikes, but clearly quickly in January, the market started, expecting really 100% chance of 5 hikes in 2022, and with some banks calling for 6 or even 7 hikes. So given the more aggressive posture or expectations, that really, caused the stock market to sell off. We've talked about this in the past. There's been definitely lofty valuations, especially in the US market. We reviewed that last time. And so definitely some air came out of the market. So you staying here, just looking at the year to date, which is just the month, you see US stocks down 6%. Non-US stocks were only down 4%. Really what drove that difference is the valuation difference between US and international stocks. And then fixed income, as rates rise, fixed income under, prices go down. So US bonds were down 2.2%. And we also hold non-US bonds really as a diversifier. This is a great environment to see that. So non-US bonds hedged, which is the middle column, in which we hold, was only down 1.4. So you have that diversification because central banks outside the US are doing things may not be as aggressive in rate hikes, especially the euro or Japan. Just to provide a little bit more context on that hedged versus unhedged in the fixed income, we hedge currency because if you don't hedge the currency in fixed income, you all of a sudden fixed income can become a very volatile asset class, and that's not what you want out of your fixed income. So to get a picture of the difference if you didn't hedge, look at the yellow column here on this page. Hedged non-US bonds were only down 3%, but if you didn't hedge that currency movement, non-US bonds were down almost 8% on a one-year basis. So I just wanted to provide that context since we really haven't talked too much about the non-US bonds lately. Let's go to the next slide and briefly look, what happened in different segments of the market, even though we hold a total stock market index, and really calling out the attention on that value and growth spectrum. It was really the growth part of the market that pulled back, and even to also the smaller cap stocks were exposed. So growth stocks were impacted because investors are looking at what earnings will be, but you have to discount those cash flows back to the present. So if you start to use a higher interest rate, the cash flows don't look as good for growth companies given their lofty valuations. So that's where we saw most of the selling. And even here in as of February, just to give you an idea, there's a technical correction. A correction is defined as a fall of 10% for small cap stocks. Let's flip to the next page. And this is talking about the yield curve. And we talk about this because, as rates rise, prices fall for fixed income. But one thing to highlight is the yield curve, which is this line over all different maturities. It doesn't move parallel. It doesn't shift the same along each duration. So where the biggest moves in the rates have been is the shorter end. So again, the market expecting Fed to increase rates, that has pushed the shorter end of the curve, see that greenish line, up more than the long end. The long end is still relatively anchored, the 10-year number, at least here at the end of January, 1.79%. It's moved up since then. But the longer end of the curve, the 10 years, more has to do with what does the market expect growth and inflation to be over longer periods of time. So I wanted to provide that context. And the next page, you look at the different segments of the fixed income market. And when you're in periods of time of stress, on the left-hand side, treasuries were down 1.9% in January. However, as you go out the risk curve, you see investment grade credit finally underperforming because spreads have widened, and you see high yield also down 2.7% just in January. So any questions or anything top of mind before I just start to review the performance of the two plans? Okay. Interject at any time, and we'll go forward one more page. And a quick recap since we are here. So given everything that I said, no surprise to see a 1-month return for the pension plan of down 3.2%. On a fiscal year to date, still eking out a small gain, up 1.47% on a fiscal year to date basis. All allocations on the bottom of the page still remain within targets. We always have cash flow going out and in on a monthly basis to give you a sense of that. We raised cash of $2.7 million in January for February pension payments. And we also received $288,000 in distributions from the private equity funds in the month of January. So we use, anytime we're raising cash or getting cash, we're rebalancing to the policy targets that you see on this slide. I don't have any other comments right here. For the most part, one more slide. With the 4 index funds across equity and fixed income, really mirror what I said at the outset, the previous slides. And then, intra month, from month to month, we don't get any change in values for the private equity. It only happens on a quarterly basis. So no additional comments for private equity or private real estate at this time. Let's see. If we forward, go to the OPEB plan, a little bit more weakness in the OPEB plan. It carries higher equity exposure. So with that higher equity exposure, we see on a 1 month basis down 3.88%, and a fiscal year to date, the gain is even smaller, only up 0.49%. No cash flows to speak of within the OPEB plan. And same, no comments on, since the funds are generally the same with the exception of a higher allocation to real estate for the OPEB plan, no other general comments. And maybe I'll flip to page 18, just a quick look out as far as as we're looking out a little bit farther than the next 12 months. So let's see. Yeah, staying right here. I guess, as far as our expectations on rate hikes this year, our fixed income team is forecasting around 4, so less than the market. However, what's different between Vanguard and the market is longer term, looking out past 2023 or beyond. And we believe that the Fed Reserve may have to increase its target to 3%. So much higher than the market is pricing in, which is around 2.5%, in order to catch up with inflation. So that would be the main difference between what Vanguard's economic and fixed income team is seeing versus the markets. And probably by the next meeting, our March meeting, I'll have updated capital market forecast below as of December. These are still as of September. It's about a 2-month lag after quarter end. And I know that'll tie into the forecast that Milliman will touch on, or that we'll review later in the year as far as setting the discount rate. So quicker update this month. If there's anything you want me to address or any questions, please let me know and I'll stay on the line. Otherwise, I'll turn it back to you, Jared.
Any questions? It's nice and brief, Brian. Thank you.
Yeah, my pleasure.
All right. Well, if there's no questions, then we'll move on to item number 4. Welcome Jen Castellano from Milliman to give the actuary's presentation on the pension fund.
Thanks, Jared. Good evening.
Thanks, Jen.
Should I share on my end, or do you have it as well, Jared? Either way is fine with me.
Let's see. Do I have that one? Yeah. Do you mind sharing yours?
No.
Oh, never mind. Never mind. I have it here.
I found it.
Yep.
Okay. All right, we can skip down to the third slide there. Okay, so this first couple of slides, I'm just going to go through some terminology for anybody who's may not be familiar with the terminology related to pension valuations. So first of all, we perform valuations for the pension plans on an annual basis. Every July 1st, we send out a census request and collect the data for updated data as of that date. And we take that data and we use it to calculate a present value of future benefits that are expected to be paid from the plan. We calculate it in today's dollars as present value. We also look at the asset performance from the year, and we put those two things together. We look at that relationship, and that determines the plan's funded status as of the valuation date. Now, the funded status can change for several reasons, due to changes in your population, due to how the assets performed, or due to any assumption changes that we may feel are warranted due to recognizing any trends that have developed over the past several years. So we always take a quick look at the assumptions as part of our process. But notwithstanding any changes, ultimately, we put these things together and calculate a contribution for the town to make towards the plan. So the accrued liability is the value of the benefits that have been earned to date as of the valuation date for past service. It represents service and pay for active employees up until the valuation date, and the expected checks to be paid to current retirees in the future, discounted back to the valuation date. The actual value of assets is equal to the market value of assets with some adjustments. We don't look at the pure market value of assets. Instead we adjust it to recognize gradually recognize investment gains and losses over a 5-year period. And when I say investment gains and losses, I mean gains and losses above and beyond the assumption. So as of July 1st, 2020, the investment return assumption was 7%. So to the extent the plan returns greater than 7%, there's a gain. To the extent the plan returns less than 7%, there's an investment loss. We don't take that hit all at once. We just recognize 20% of it in each year until it's fully phased in. The benefit of that is that it shields the plan from any adverse market fluctuations to keep the contributions as,
Stable.
to limit the volatility.
Yeah. We get it.
And the unfunded accrued liability is just the difference of your accrued liability and your actuarial value of assets. It's the deficit. And your past service cost is the amortization payment that you're making each year to pay off the unfunded liability to get to the plan to 100% funded. You're currently at a 20-year period as of July 1st, 2021. So I talked about the accrued liability. The normal cost is the value of the benefits that are expected to be earned in the upcoming year. So just for the next year. We take that and we net out expected member contributions to the extent that employees are contributing, that reduces the normal cost dollar for dollar. And then we add in any administrative expenses that are expected to be paid out of plan assets, such as legal fees, auditor fees, actuarial fees, not investment advisory fees. Those are considered investment expenses, so those are treated separately. And put those 3 things together and calculate what is known as a net normal cost. The net normal cost, in addition to the past service cost, it makes up the actuarially determined contribution. And then we also adjust it for an interest component to take into account the fact that the lag between the valuation date and when the contribution is actually made into the plan. So on this page, we have a graph of the plan's population of both plans' population over the last 5 years. And for the town plan, you can see the active population has been declining because the plan has been closed to new hires for several years. And in the 2021 plan year, there were a lot more retirements on the town plan than usual. There was an early retirement incentive program that was offered, and that a lot of individuals took advantage of. So that was the main reason for those retirements. But there were also a significant number of retiree deaths, almost double what we were expecting. So that produced some gains to the plan on the liability side, which you'll see how that comes into play in just a bit. That's why you can see that in the light blue shaded area, the retiree population, the members who are currently receiving benefits, that stayed fairly level, even though a lot of people retired, because there are also a lot of retirees who passed away. So it stayed level year over year. On the police and fire side, there were.
Can I ask a quick question?
Sure.
I'm just curious. Is this a phenomenon you're seeing across similar call them peer plans, or is this unique to Fairfield for some?
It's
Random.
I really haven't seen much for trends. It's kind of been all over the place depending on the plan. You know, some of the deaths that we saw were deaths that happened prior to the last valuation date. They just weren't picked up last valuation date, but majority of them did happen in the last year. I mean, in the current environment with where we're in the middle of a pandemic, it's not too surprising. Majority of the deaths were much older people in their 80s and 90s, but it's not necessarily common, but it's not also uncommon. So it's kind of, I haven't seen any trends for my clients really.
Thank you.
So on the police and fire side, there were also more retirements than expected. People retiring a little earlier than expected as well. But they were replaced by a lot of new hires. The police and fire plan, as you know, is still open to new hires. So the active population, the purple section, stayed fairly level. A lot of people retired, but they were replaced with younger, newer employees. But on the police and fire side, there were very few retiree deaths, so fewer deaths than we actually expected. And given that the police and fire plan, the normal form is what is known as a joint survivor form of benefit, where the benefit's payable not only to the retiree, but continues on to their spouse if they're married and their spouse outlives them. We are unaware of any spouse deaths as well, so that produced some losses to the plan. So the liability experience on the town side was favorable and produced actuarial gains. The liability experience on the police and fire side was not favorable and produced actuarial losses. And you'll see how that kind of comes into play with the numbers in just a moment. But before I get there, I just wanted, this is just a graph we like to show. It's a kind of a heat distribution, age service distribution of your active members to get an idea of the age and service characteristics of each plan. On the left of the town plan, you can see that it's a more mature plan. It's been closed. There's no new or younger people coming in. So there's a significant number of people who are older and longer service. In fact, about 40% of the plan is actually eligible to retire in some way, shape, or form as of the valuation date this year. So, you know, it is an older maturing plan, but that's not unexpected given that it's been closed for several years. On the police and fire side, you can see that the distribution is much more spread out evenly. You can see a significant number and 0 to 4 years of service. I told you there was a lot of hires recently, so that's why that's there, but it is fairly spread out. And I don't expect as much of a mass exodus on the police and fire side as the town side, given that it's open and it's just having fairly regular turnover.
Jen, can I get a quick question? What would you expect to see as far as eligibility to retire? Is 40% pretty typical?
Early retirement. No, well, yeah, for a closed plan that is aging, that's not surprising. If this was an ongoing plan that had a lot of new hires, that would be surprising. It would mean that you don't have a lot of new hires because people just want to work for the town forever and don't leave. But that's not unsurprising for a plan that's been closed to new hires for some time. Now, this is not representative of the total active population for the town because it doesn't reflect anyone who's been hired in the last several years. But yeah, the retiree count I would expect to start increasing fairly significantly over the next several years.
Okay, thanks.
Jen, Eric Caliper here.
Mhm.
I'm looking, I know the town plan's been closed for several years, and I'm
Yep.
looking at, there's 3 individuals that have 0 to 4 years of service. Do you know when the town plan was closed?
It depends on the union. It was closed several. I think the last group might have closed like within the last couple of years, 2 or 3 years. So there might be some Board of Ed groups, I believe, or those could just be some questionable data we might have received, so that I could take that as a takeaway to look into for
Just
for
looking
next
at
year.
the ages and the service time, and I'm
Yeah.
like, that's like a strange outlier for someone to be in a pension plan.
Agreed.
Okay.
So yeah, I'll take that away and look into that.
Thanks.
Eric, the last member on the Board of Ed side is currently, is in his early 30s. So
Okay.
that's the last, I know that for a fact, so.
So there
I'm
could
not
just
sure.
be something we need to investigate there. Okay. Moving on to the asset side of things. So as you all are well aware, the fiscal year 21 was a phenomenal year for the plan's investments. This slide is showing two different representations of assets. You have the market value of assets and the actuarial value of assets. And as you know, the actuarial value of assets is a smooth value. It phases in the investment gains and losses over a 5-year period. On the left-hand side with the market value of assets, you can see the assets jumped up significantly in the last year due to the strong asset performance. And even over the last 5 years, there was a little bouncing around and a big jump in the last year. Whereas on the actuarial value of assets, you can just see a steady increase year over year over the last 5 years. And that's exactly why we smooth assets, is to provide a steady increase, still moving in the same direction as the market value, but not bouncing around and adding volatility to the budget. The last thing to note is you'll see that the market value of assets is currently higher than the actuarial value of assets. That's because we've only recognized 20% of that large gain this past year, and the other 80% we'll recognize over the next 4 years. All other things being equal, those gains that we have not yet recognized will help to put downward pressure on the contribution or offset any potential future losses. So those are, that's why we smooth the assets to kind of protect that, the status of the plan. On this page is another picture showing the relationship between the market value and the actuarial value of assets. The darker green boxes represent the return over the last 5 years on a market value basis. So you can see, kind of bouncing all over the place. Obviously, the huge return this past year standing out quite significantly. But the lighter green line represents a smooth value of assets. So that doesn't bounce around nearly as much, and it's clearly much more stable over time than the market value of assets. So that's that. On to the next slide. So this is looking at the funded status of the plan. The accrued liability has been steadily growing year over year, and that's expected. Members are actively accruing benefits, so benefits are getting larger for your active members, and time is moving on, so we expect the liabilities to grow. And now I did say that on the town side there was a liability gain, and you can see in the top right graph that the funded ratio for the town plan jumped from 84% last year to 87% this year. This funded ratio does reflect the change, the interest rate assumption to 6.9% that you voted on last summer. So even with a lower interest rate assumption, the town funded ratio went up. So factor of two things: the liability gains I spoke of, as well as the strong investment performance during the last year. So both favorable things happening help to increase the funded status of the town plan. However, for the police and fire plan, you can see that it decreased a bit. So there was strong investment performance for the plan, but that was for the most part completely offset by the liability losses that were suffered by the police and fire plan. So it was a slight deterioration in the funded status as a result. So putting all that together gets you to the actuarially determined contribution for the year. And you can see in the blue section, the town contribution dropped about $500,000 from 5.6 to 5.1 million, roughly a 10% decrease. But the police contribution went up almost $700,000, and again, roughly a 10% increase. So net, there was just an overall slight increase for both plans combined, but due to the losses on the police and fire side, the contribution did go up more more significantly than, and in the town side, there was a decrease. And again, these are all at 6.9%, these results. Any questions up until? Okay. So,
Hi, it's Brian. Do you mind if I ask you a quick question? As far as the funded status, how looks like it may be different than, can you explain why it would be different than what's in the CAFR? Or
sure. The main difference is due to the CAFR represents the market value of assets. So at 6/30/21, that entire large gain due to this stellar performance in fiscal year 21 was recognized in that funded status. Whereas for funding purposes in this funded status, only 20% of that gain is recognized. So it's more muted. But with time, assuming nothing else changes, that those will help to bring the funded status up over the next 4 years or so.
okay, thanks for clarifying. So the CAFR is market value as
Yes.
opposed to actuarial value, which you already covered. Great, thank you.
So this slide, and I know we already, we voted on the interest rate assumption. You voted on the interest rate assumption, and that's been decided. But I just wanted to provide some background about as to how we evaluate the interest rate assumption each year as part of the valuation process. So in the top right, this is a graphical representation of the plan's current asset allocation as of June 30th, 2021. The larger the bubble just means the larger allocation to that particular asset class. Along the y-axis is the expected nominal return. Along the x-axis is the risk or the volatility associated with that particular asset class. And then the little black dot is where your portfolio sits in aggregate and along on that front. Down at the bottom, we show a distribution of expected returns over different periods of time. So in any given year, you can expect the return to range from a very high return to a very low return. It's not going to be stagnant and consistent year to year. But over time, and as we look at longer periods, we expect those high years and low years to kind of balance each other out. And the annualized return should converge towards the 50th percentile or the median. Okay, and so we're looking at a 30-year period here because this is a pension plan, and which is a long-term obligation. We're talking about paying benefits for the lifetimes of your members. So we like to look to 30 years, sometimes even more. And on that basis, we're coming up with a return assumption of about 6.1%. As it compares to your 6.9. So just something to keep in mind just for some education purposes. And of course, this is based on our June 30th, 2021 capital market assumptions. We will update these again at June 30th, 2022. We update them every year. And, who knows, what will happen between now and then and where those assumptions will fall, but we'll keep an eye on it. And again, and obviously we reflect any potential changes to the asset allocation as well that could change what the expected return is. But right now there's a decent gap between where we expect you to be and where you actually are. And that's important. If you go to the next slide, this is intended to serve two purposes. One is to show you if all assumptions come true, what you can expect the contributions to be for each plan over the next 20 years or so. So the bars on these on both these graphs represent the investments return 6.9% year after year. There is no actuarial gains, and everything happens exactly as we expect it to. Of course, that's not going to actually happen, but if it were, you can see for both plans, about 5 years out or so, the contribution declines for about 5 years or so, and then it kind of levels out. And that's because that's where we expect you to get to about 100% funded. And at that point, you're just paying the normal cost. You're not paying that amortization of unfunded liability because you're at 100%. So you're just paying the value of benefits earned. For the police and fire plan, it's staying fairly level because that's open. There's new people coming in. The town plan, you see it dwindling away because that plan is closed to new entrants, and eventually this plan will have no more active employees who are accruing benefits. Now, there's a couple other lines on these graphs. You see this light green dotted line and this slightly darker green dotted line. The light green dotted line is what happens if the plans persistently underperform by 100 basis points year after year. So we're at 6.9%. If the plan returns 5.9% year after year, which is not too far off from what the 6.1 that we calculated, it's a little less, but you'll see that it kind of follows the same pattern for the first 5 years or so, but then it starts to deviate and gets higher and higher and higher as time goes on, because the investments are just not returning enough to make up for the shortfall in the assumption. The liability is being valued at a much higher rate, which is producing a lower liability, and the investments are not picking up and keeping up and growing at the same pace as the liability. So it's something that's a long-term consequence of persistently underperforming, which is also known as having an interest rate assumption that's maybe too high. So just some food for thought, something for everyone to keep in the back of their minds as we move into discussing the interest rate assumption later on this year.
Jen, Eric Caliper here. Just a quick
Sure.
question on that last slide. So I believe you said that we reset the 20-year amortization rate to last July.
As of July 1st, 2021, it's at 20 years, and it's expected to decline by 1 each year going forward.
So where would that decision made? I thought we were 6 years into a 20-year amortization last time, or
as far as I understand, that it was 21. It was 21 last year at July 2020, based on the information that we received from Hooker and Holcomb, and it was 22 years prior to that. So I think maybe about 5 years ago, you might have voted on a 25-year period. I'm not. I don't have that history, but this is just continuing on the same amortization period that was done in the past. We haven't changed that at all.
that's what I was checking out. Awesome. Thanks, Jen.
Yeah. So on the next couple slides, I'm not going to go into too much details on these. These are just for people who like to look at a lot of numbers. That's what these are. It's all the nitty-gritty detail of this different scenarios. Both slides show the 2020 results that Hooker and Holcomb performed. We did a full replication of the results, and you can see that we matched them very, very closely, within like 0.25% or something like that. So our end result was a contribution that was not far off from what they came up with. In an actuarial world, this was a bullseye. So we were very happy with that. And then we move on to 3 scenarios for the 2021 valuation. What the first is being what we call our baseline scenario. That's just updating the assets and the census information, but all other assumptions remaining exactly the same. Then we lowered the interest rate to 6.9%, as was voted on by the board about 6 months ago. And then the last scenario is a recommended change we're making to how the interest component of the contribution is calculated. Hooker and Holcomb's methodology, we don't believe provided enough interest to take into account the timing lag between when the valuation is performed, the valuation date, and when the contribution is actually made. So we recommended that to make this change so that you're really taking into account the timing difference properly and giving a full year of interest at the assumed interest rate. And it's likewise for the police and fire plan, same details for those that are interested. And those are the results of the 2021 valuations. Now, I do want to add, I talked about some gains and losses on the liability side for both plans, and I believe we're scheduled to perform an experience study this upcoming year. I think the last experience study was performed 5 years ago, and I think it's an opportune time to take a look at the assumptions and see where we can tighten some things up and maybe have a better picture of what the future expectations are to help avoid any future gains or losses going forward.
Is everybody done there? Can I stop sharing that? Or anybody want to refer to that? Okay. All right. Jen, thank you so much. Are there any questions, any other questions for Jen?
I have a question that reflects my being a newbie here. Is the interest rate assumption that we're using comparable to what our peers are using?
Yeah, it's fairly comparable. The interest rate assumption is kind of all over the board across the state. In Fairfield County, I know communities not far from where you are that are using 6.8, 6.9. I also know some that are using 6.25. So it's kind of all over the board. But I'd say you're a little bit on the higher end relative to some of the other communities.
Yeah, I would echo that. Just looking at Fairfield County, we update something once a year. Maybe we'll do it for the next meeting. But the short answer, Tom, is that every plan has a different asset allocation, and therefore the discount rate will be different. And that asset allocation is kind of based off of, what the funded status is. So some plans that have a funded status at 100% or higher might have less risk in the portfolio, therefore a lower discount rate. So keeping that in mind. But I will say the trend definitely in Fairfield County, but nationally, is that to keep, as plans keep reducing that discount rate due to how low interest rates are and the high valuations in the market. So plans have been gradually, you don't do it big jumps, but gradually reducing the discount rate.
Thanks, Brian. Thanks, Jen.
Yeah, also, and Jen, maybe you can comment more on this, but it's not just about what the discount rate is. There are different factors and assumptions inside each of the plans. And so I think, to get a true picture of how our plan compares to another town, I think you really need to look at all aspects of each of the plans and what the assumptions are.
Yes, I would agree with that.
All right. If there are no other questions, again, Jen, thanks very much for your presentation.
My pleasure.
You're welcome to stay around, or you can leave.
Thanks, Jeff.
Have a good night.
Thanks.
Thank you, Jen.
Okay. We'll move on to item 6 on the agenda, which is the IPS review / vote for acceptance. I sent this out. I sent the most recent version out earlier today. We can take a look at it and decide whether or not you want to. We don't have to vote tonight. So if you want to take a, look at this longer, spend more time deliberating about this and whether or not there should be changes, we can do that. So would you like me to put it up there at least so you can see the most recent asset allocation? I can share my screen. Okay, so as a reminder, I believe it was September, around the middle to end of September, that we last voted on the asset allocation, and the main change was to a redistribution in favor of higher percentage toward private equity. And Brian, jump in here, or anybody else jump in here if you want to add anything to that. And I, at this point, we can take a look at this. I welcome any comments, suggestions. Brian, if you have any suggestions about or recommendations whether or not we should be moving at this point, glad to hear it. So I'll just open it up to everybody.
Yeah, as far as the asset allocation targets reflected here, in the IPS, that matches the actual targets that we have, say, in the performance report. So those, we're all in sync as far as the targets or the IPS versus our actual or projected asset allocation. So that's in sync. I think later this year, it'll be the continuation of that discussion that Jen brought up as far as the discount rate. And so what I mean by that is, like, let's just say if the discount rate, you keep the current asset allocation of roughly a 60-40 portfolio, maybe prudent to reduce the discount rate. The other thing is, okay, we want to keep the discount rate at 6.9. Well, then in order to get to that, you might have to increase risk in the portfolio, maybe add more equity exposure. Or just as an example of the different levers or how they play out. So I think that's a discussion for later in the year as we come closer to the end of the fiscal year, if I'm not mistaken.
Any other comments on this?
Now, I just have a question here. How often do we look at these, and
Sorry, you got cut off there, Jim, at the end.
often do we look at this schedule? Have we changed these in the
So last year, I believe we changed it twice. Once in March, or we ratified what was already existing in March, and then again in September. I believe, actually, I think the dates are actually in this document. So there's the history of it, Jim. You can see in March 24th and September 22nd were the last two changes or approvals.
I have a question that may seem,
We're required by town code to look at it once a year and either vote to ratify the existing or make a change to it.
yeah, I was a little confused by that. Somebody at one point mentioned it had to be approved every 6 months. I see here biannually, and then per the code, as you just mentioned, annually. I'm just curious, why do we have, if I'm understanding it correctly, 3 different periods mentioned, or is it that's just the way it is?
Mention where what are you referring to?
Well, right now we're looking at, it says board will review the IPS at least biannually, so every 2 years. And I understand
I see.
the town code says every year, and then somebody else, I apologize, I don't remember who it was, said we're voting on this every 6 months, which is maybe out of an abundance of interest in keeping current. But I'm just curious, we have various periods flying around. I'm just curious if there's a rhyme or reason to it.
Eric Caliber here, I can only speak from experience. Typically we have this discussion whenever we look at the entire portfolio and we want to make asset changes. And it's typically somewhere around the time we have or close to a discount rate discussion. So typically they have been within a year or 18 months of each other, historically on the board.
Thanks, sir.
I think just additional context of the March 24th date of where there was changes is that was really catching up from allocations that were done in 2020. But I think there was a waiting period to wait for the new board to come in and then kind of vote and clean up the IPS. So the 2021 date was reflecting some allocation changes that were made in 2020. And then the latter one was more reflective of the increase to the private equity. So
Brian, on that point, if you don't mind, or anybody else, the private equity target was increased. Did something else go down?
the public equities, yes. So the private equity went from 5% to 10%, and then a corresponding decrease from both U.S. equity and international equity, but that 5% coming from public equity, because whether it's public or private, it's still equity.
Still equity, yeah.
So that's how we kind of fund it.
Thanks, Brian.
All right. If there are no other comments, we'll hold off and that'll just be a review for tonight and won't take a vote on a change. And if there's nothing else, we'll move on to number 7, old business.
did you ignore number 5,
I'm sorry.
the RFP? The
Oh,
RFP for the
yeah,
payment?
yeah, my apologies. I skipped that one. Okay. Let me,
Thank you.
yeah, let me go. Thanks for reminding me. So number 5, I believe we brought this up during the last meeting. And let me stop sharing. Okay, I believe this came up last meeting. There has been some issues with the I guess the way that that statements are maybe appearing in what People's Bank and the service that they provide. And so we talked last year, almost, got to the 11th hour of switching to a different company to provide the payment processing services. And so, we were in a bind at that point because at the time People's was going to stop providing the service, and then at the 11th hour decided to continue to do it. And as it turns out, we're not happy with what they're doing, and so I think we want to revisit this and look for another company to provide the payment processing services that can give us better and give the retirees better information on when they get their checks. So all I'm asking for today is a vote, and I would take a motion to for the town to move forward with an RFP to seek another company to process these payments. So I'll ask for the motion now.
Jared,
Sorry, Jim, couldn't hear you.
got a motion and you need a second?
Was there did you motion it, Jim?
Well, I can. It's just for the town to put out an RFP, right?
That's right. Yep.
I'll make that motion for the town to put out an RFP for that service.
Thank you. Is there a second? And Tom Collimore's a second.
Second.
Any questions, comments, recommendations? Okay, seeing none. All's in favor of proceeding with this RFP, say aye.
Aye.
Any opposed? Any abstentions? That item passes. All right, now we'll skip forward to to number 7, old business. Anything there. Any new business in number 8?
The only thing I have under Eric Caliper, the only thing I have under new business is just that we talked about it briefly. If anyone has any pension statement issues, just to have those executive board members of unions just to contact human resources, and they'll work through the active members' issues. So that was good to hear.
All right. And if that's all there, we will go to number 9. Could I have a motion to go into executive session with a potential vote to follow? We have, before I take the motion, we have on the line Jim Baldwin, town attorney, and also Matt Tusillo, who is counsel to us. And at this point, I would take the motion.
Eric Caliper, I'll make a motion. We go into executive session.
I'll second.
Jim Brown seconded. Jim, do I need to move to take us out of special session?
Yes,
Yes.
I need a motion
Okay.
out of executive.
Could I have a motion to come out of executive session? Okay, Jim Brown moved it. Is there a second?
Second.
Eric Caliper seconded. All in favor, say aye.
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 Any opposed? Any abstentions? Okay, we are out of executive session. And I would take a motion to approve the class-wide settlement for all claims in the case of Chun versus Floor Corp in the Northern District of Texas.
I don't take shorthand, Jared.
Jared, do you have to say that we took no votes in executive session?
Yes, I apologize. We did. There were no votes taken in executive session. Okay, ready, Chris?
I'm ready. Motion 2.
Okay, motion to approve the class-wide settlement for all claims in the case of Chun, CHUN, versus Floor, FLUOR Corp,
FLUOR Court.
in the Northern District of Texas
Mm-hmm.
for the sum for the aggregate amount of $33 million.
Okay.
Got that? All right, so I
Got
would
it.
take a motion to approve that.
Jared, did you make the motion? You're asking someone to make the
I'm
motion.
asking for the motion. Okay, Jim Brown
Jim
moved
Brown?
it. Is there a second?
Eric Caliper will second.
Eric Caliper seconded. All in favor, say aye.
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 Any opposed? Any abstentions? All right, the item passes then. Okay. Unless there's anything further, we are done, and I'll take a motion to adjourn.
I move to adjourn. Tom Collmore.
Tom Collmore,
Eric Caliper will second the motion.
Eric Caliper second. All in favor of adjournment, say aye.
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 Any
Aye.
opposed? Any abstentions? We're adjourned. Thanks, everybody. Have a good night. Thank you, Matt. Thanks, Jim Baldwin.
Good night. Thank you all.
Okay.
Good night.
All right.
Thanks, Chris.